Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy. Fine.
Good morning, everyone, and welcome to another episode of Financially Raw. I haven't been on for about 3 weeks, so to get all the right buttons pressed takes a little bit of time. So welcome, and I'm looking forward to spending an hour with you talking about a very, very interesting topic today. We have our in-studio guest, who's Frikkie van Loggerenberg. And Frikkie, let's put you on so that the people can see who you are. Welcome. Thanks for joining me this morning. And tell us a little bit about yourself. Tell us about Frikkie van Loggerenberg and IFSA.
Will do. Lourens, thank you so much. Thank you for having me. It's always wonderful to come and have a chat around something that we are so passionate about. Frikkie van Loggerenberg, I'm actually Afrikaans. Believe it or not, but yeah.
With a surname like van Loggerenberg, I would think it's Afrikaans. It's like overalls.
Exactly. So yes, in the financial services industry for 20 years plus, specializing, focusing on single premium investments, investment management strategy, and then the last, I would say, 10 years specifically focusing on alternative investments.
Okay.
That's the main drive.
Okay, awesome. So, Frikkie, tell me, we're going to talk about private equity, which is the new buzzword. You spoke a little bit before the show. You said that when you started into private equity, it was not something that was spoken about a lot. People didn't know about it. Now it's sort of everybody's talking private equity. I see people on TikTok, and they all, we invest in private equity, but nobody knows what it is. So what we're going to talk about today is what is private equity, and is it something that people need to consider as part of their investment portfolio? How did you get involved in private equity? How did that start for you?
I think we chatted a little bit. We touched on it beforehand. What happened is in 2008, 2009, we went through a process that out of an investment management perspective, you picked the right asset managers, you picked the right stocks, and the other side of the world happened, and all of a sudden investment management, you got 30%, 40% less capital for your investors, and they started asking questions. Shouldn't you have known that things like that would happen? So you flabbergasted because you did everything right, like the book said. And right there and then, I started to think there must be a way where you can actually hedge against these events, that you've got something that you've got more control over. Okay. And then from there, moving over to more of the hedge fund space, but it's more, that's also in the listed type of environment, which has got the same similar character traits that the normal vanilla shares do. So focusing on private equity was the next step. Private debt came along a little bit closer, but we'll have a conversation on that now. And then the private equity was a passion starter, igniter for me, because now you've got real value that you can take a look at. The investments that we do, we've got somewhat control. We've got sitting on the boards of these specific companies, and we know what the value is that we can add. Okay. And that felt to me like there's actually some margin of control, and within a nice diversified portfolio, it plays a pivotal or a very, very important role in portfolio construction.
Okay, and we'll talk a lot about that. And as you're talking, I'm thinking, well, the more control you have, you're hedging the risk, which means, okay, it should be a little bit less of a risk, but people tend to think that private equity is a very high risk investment, and we'll talk about risk as we go along. So if you have any questions, you are welcome to give us a shout out. On the Berg Studio website, there's a little shout out button at the top. You are welcome to then give us a shout out. Just press that. You can ask us questions directly in studio, directed at me or at Frikkie, hopefully at Frikkie more than me. And then also on the screen, you will see the WhatsApp number. It's 082-801-6693. Please don't ask questions on the social media channels. as we cannot check all the channels at the same time. It's only me in studio, so I'm running the whole show, so I can't have access to YouTube, LinkedIn, Facebook, and all the social media channels at the same time. So if you have a question, the WhatsApp number is on screen. WhatsApp us in studio and we will be happy to answer your questions. As per usual, we're going to have some music break, and the playlist comes from Frikkie today, and he said to me very confidently that it must be the best playlist I've ever had. So we'll see what you guys think about it. And then also, those of you watching on social media, unfortunately, you can't enjoy the music with us because we cannot play the music on social media. So for you guys, we're going to have a short video that you can watch while we're on the music break. And this is all about our financial coaching system. iRetire has a financial coaching system which we teach people to help guide them to get to financial retirement. So you can have a look at that. So let's go for our first music break. We're going to have a look at the financial coaching for those of you on social media, and we will be right back. Okay, so let's talk a bit about iRetire's coaching system and how do we guide you through this. So our coaching has 4 different stages or 4 levels that you go through, and you graduate from the one level to the other level. The benefit for that is that you actually have a good idea of what your path is going to look like, what to expect. Although you won't understand everything, and on each of the different levels you'll know exactly what's going to happen there, you have a route, a map to show you what you are going to go through. So I'm going to share that with you in generalities, just to give you an idea of the route that you go through. So the first stage is what we call the student level. So on student level coaching, the first thing we're going to look at there is cash flow management, making sure that you have a proper budget, and move your zero back to zero. So moving your zero back to zero is something that is so important when you start on this journey. That means getting rid of all your unsecured debt. So how that works is, and this is something that a lot of people don't understand, as you start working when you are young, your first couple of salaries, you earn some money and then you spend money, but you can't go below zero because your zero is zero. So you earn money and you spend money, and you earn money and you spend money, all around zero. And then the bank comes and tells you, wow, you're a good client, we're now going to give you a credit card. And you're very excited because you're now an adult and you can't wait to get that credit card because that shows you that you've achieved something. But you promise yourself that I will not use this credit card unless it's an emergency. And then what happens? Very quickly, that credit card goes to minus 10 or minus 15,000 Rand. And now what's happening is you are now moving from minus 10 to 0 and back to minus 10 and to 0. And I see so many people who earn huge amounts of money that justify to themselves by saying, yeah, but I clear my credit card every month. So I'm okay, I still clear it. But now you're on the wrong side. Your zero is not zero. Your zero is now minus 10 or minus 20,000 Rand. But you're doing exactly the same thing that you did previously. You're moving to minus 20 and then you build your money up to 0 and then you go to minus 20 and 0 and minus 20. But now the bank is starting to get their claws into you, and the bank is starting to earn money from the things that you do. And then slowly but surely the minus 20 becomes minus 30, minus 30 becomes minus 50, minus 60. And if you keep this going, what happens? The bank will contact you and say, well, you are now qualified to upgrade your credit limit from 20,000 to 30,000 Rand. Would you like to accept this offer? And you will go, I don't really need it, but yes, it is there. Let me do it just for in case. And before you know it, your zero is now moved to minus 30. And then it happens again and your zero gets moved to minus 40, minus 50. So the first thing we want to do is we need to get your zero back to zero. Guys, it is pointless for you to invest 1,000 or 2,000. Welcome back, everyone. And I hope you enjoyed the music. What was the song? Yes, I've got the memory of a goldfish. What did we listen to? Brown Eyed Girl from Van Morrison. I hope you enjoyed it. And those of you on Berg Studio, you are watching our video on our financial coaching. So if you want to watch the rest of the video, I don't know if we're going to be able to get through the whole video this morning, but if you want to watch the rest or go and see any of our other educational content, please go to our YouTube channel. You just search for I Retire on YouTube. We've got over 300, I think we're sitting close on 350 educational videos, anywhere from budgeting to starting a business, to business ideas, to investing, to medical aid, anything regarding financial, you can get there. So go and see all the content we have on there. And when you like and subscribe to the channel, it helps get us more people to watch it. Okay, Frikkie, let's start talking about your about IFSA firstly, and then about private equity. So IFSA, when was that started? You are the founding director. You started the company. You spoke about that you started a few other funds, and now you've started IFSA. Where did that come about? How did you start IFSA?
So IFSA came about as a normal Category 1 advisory business.
Okay.
That actually the license or the entity started in 2000, believe it or not. So
Okay.
I took that over around about 2007, 2008 there, and focused on normal vanilla unit trusts, share portfolios, investment management back in the day. Then going over to private equity, moving into that specific space, that got a focus. So what we did is we had external risk managers, guys that have done private equity long before me, that helps us to set up structure and manage the risk for us. And after a while, finding our feet, seeing exactly how it should be run, and having this immense passion for this business, we went out and we got our Category 2 investment management license in 2017, and we've been running portfolios. And one of our flagship portfolios is our Cornerstone Capital Private Equity Fund that we've been running from there. Nice track record, decent fund. But we have established and exited 2 other funds in the interim over there as well.
Okay.
So we've got a lot of experience in good markets, bad markets, up markets, down markets. So we've got a very, very good idea of what the possibilities in the investment arena is.
Yes. Okay. So I think what we need to start with is explain exactly what a private equity fund is. How does that differ from the typical unit trust or the exchange traded funds that people are now used to, or normal equity funds like the LC40 and those kind of funds? How does private equity differ from those funds?
I've got no idea. No, joking. So there is one major difference between your traditional funds, if I can say your traditional funds, and then your alternative or your private market funds.
Okay.
So the major difference is listed versus unlisted. So it's equity or debt, it doesn't matter which way it goes, but one is publicly traded listed instruments or listed shares in businesses, where private equity and private debt is unlisted.
Okay.
So that's the major difference between the two. So out of a structuring point of view, if you take a unit trust, for example, you've got a housing mechanism, you've got a name, you've got an investment manager. They choose the shares to invest in. You get a return, you get your statements, and Bob's your uncle. With private equity, it's exactly the same. You've got a structure that houses the capital, investors vest. We've got an investment manager that chooses what investments to invest in. You get your return, you get your statements. So it works on very the same type of way.
It's just what they invest in that differs.
Exactly. So I always tell people that it's not competition for your unit trusts or your listed instruments. It's a different asset class. And once you've started thinking about it as a different asset class, it makes sense. Because if you've got asset class, you've got property, you've got cash, you've got bonds, you've got equities. If you just put a private equity as an asset class into that equation, it starts making sense. That it's not competition that you have to invest all your money in the specific asset class.
Yes.
You will not invest all your money in one property. It doesn't make financial sense. So if you start taking a look at it as an asset class on its own, it makes sense.
Yes. Yeah, so you must look at it and say, well, I've got some money in equity, I've got some money in properties, I've got some money into bonds, income fund, money market fund. This is just another avenue that you have money invested in.
100%. And what I like about the financial planning or investment management process that a lot of the newer generation investment or advisors do go through, they go through a process where they start off with the end in mind. They take a look at a client's portfolio. This is the amount of capital that you've got in your various products or whatever the case is. This is your return profile that you need according to what your growth strategy is or what your income need is.
Yeah.
And then you go and take a look at what the asset classes are that can get you the closest to your goal. After the asset class allocation, that tactical, then you go and look at the product. And you start to look at the specific funds that you can use to allocate to that point.
Okay.
So I like that approach because you've got a very systematic approach onto what your allocation should be. X amount into property, X amount into equities, and X amount into private equity.
Yes.
So that to me makes sense if you start to look at that process.
So that is mostly how you approach it. You will look at an investor and say, listen, this is what we are looking to achieve. This is what we would say, how much of your money you need to put into private equity as part of your whole diversified portfolio.
Correct. So the name for our local private equity fund, we've also got a private debt fund. We've got an international collective investment scheme. We've got an American-based fund as well, and it carries the name Cornerstone, which is the Cornerstone brand. And that is how I like to take a look at it. That the private equity or the Cornerstone funds is the cornerstone of your entire investment portfolio.
Okay.
So that's how I like to take a look at it.
Now, explain the difference between private equity and private debt and how you guys put those two together to create returns for clients.
100%. Private equity is holding an equity stake in an unlisted company or business, where the idea or the plan would be is to buy the business at a certain amount, or a share in the business for a certain amount, grow that business, and at a point in time have an exit strategy, either do a management buyout or list the business or whatever the case is. So we start to know and we plan exactly what the strategy would be on an exit, and that gives you capital appreciation. But the situation there is it's not a very liquid type of strategy. So if you've got a need for liquidity, you cannot only 100% position yourself as an equity player in an unlisted business. There is a liquidity trap.
Yeah.
So what we did is we preempted this because clients and investors need cash flow. I mean, with your strategy, it's 100% cash flow is what you need, and that's where the private debt comes in, where we basically take out banks as such and provide a debt facility to these businesses or certain opportunities to grow. They pay a dividend or they pay a yield for that facility, an interest plus capital over term, and that's how we develop our cash flow scenario for our funds. That provides us that movement in the fund.
Yeah, let me explain what I understand, and you can tell me if I'm understanding it correctly. And that's exactly why you add the debt to the capital investment as well. Is if you look at a publicly traded share, that share is bought and sold the whole time. It's back and forth,
Correct.
back and forth on the JSE. Therefore, you can see when the price goes up, your investment grows. When the price goes down, your investment shrinks. With private equity, there's not 100,000 people that's buying and selling shares. You bought the shares. So
Correct.
the growth only happens when the company actually grows, and that can be 2 years, it can be 5 years, or whatever. So to generate return and cash flow, that's why you bring the debt into it as well.
100% spot on. The strategy there is to have a hybrid between the two, where it depends on what the opportunity is, more equity or debt, depends on what you forecast in your fund, and market dictates what we need to do there.
Yes.
But the nice thing about private equity, versus the listed environment. You've got a share that's got a specific price on the JSE. If you sell that day, that's your effective price.
Exactly.
But it's very noise driven. There's a lot of sentiment that drives the up and down. Where we
things that have nothing to do with the actual
nothing,
business.
absolutely
it's
nothing.
Just,
It's the funniest thing, but we have to chat. We'll chat on that now. When it comes to private equity or private debt, valuation is 100% key. So we've got external actuaries that do a month-to-month valuation on all our specific investments and report that out to our administrator, and then they report out to the clients. So we've got an actual snapshot of what the actual market value of those underlying investments is. Okay. So we've got a month-to-month actual of what actually happens in that process.
Okay. Well, what I'm going to do is we're going to take another music break, and then we'll come back and we're going to talk a little bit about how do people start investing in private equity, what they should look at, and then also what I want to talk about is the kind of companies that you guys do invest in from a private equity firm side or investment company side. So for those of you watching on YouTube and on Facebook and all the other social media channels, we're going to go to the financial coaching video again. You're going to watch that, and those of you on 1,000 Rand into some kind of investment or savings vehicle where you're going to get 4% or 5% return on your investment, while you are still paying 18, 20, 22% on unsecured debt, on credit cards, personal loans, overdrafts. You still, if you get 5% interest, you're paying 18% interest. You are losing 13% per month, per annum. 13% you are in the hole. So I see so many students and clients, when we sit with them, they are paying money into this RA and they want to save for retirement, but they're paying 18% on debt. Let's first get rid of that and then we move over. So the first one, the goal for student level is to create financial stability. So what does financial stability mean? Your coach works with you to make sure that you understand exactly where your money is coming from. You understand the deductions, you understand where your money is being spent, and you take control by implementing a cash flow management system so that you have control about the money that goes through your account. The problem is most people have no control over the cash flow. Even the ones that think that they're doing a proper budget, they still don't know, because they're spending money on their credit card, they're spending money on their savings account, on their second credit card, on their check account. They don't know what they are spending. And then the education area we focus on student level is increasing your financial intelligence. So there we focus on the basics. We teach you the rules of the game so that you understand that. Once your 0 is to 0, we then move you to undergraduate level. And as at undergraduate level that you start building your reserve account. So the goal there is to reach maximum reserve level. And what is a reserve account? It is basically your emergency fund. But in our coaching model, the reserve account is a little bit more than just your emergency fund. It has a portion for emergency fund. So that is for anything that can go wrong, like the car breaks down, somebody gets ill, the kids have to go to the hospital or to school, to the doctor, or anything like that might happen, any emergencies that might happen. But we also add CapEx, capital expenditure, because CapEx is usually what gets people into debt in the first place. Because when people budget, they budget for their monthly expenses. So they sit there in the beginning of the month, look at their little Excel sheet and say, oh, okay, so this month I have to pay for the house, the car, the credit card, the overdraft. I have to pay for groceries. I have to pay for fuel, blah, 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 the whole thing. And then they have like 500 Rand left and they say, oh, okay, we're going to be okay. But then something happens. The car needs a service. That's going to cost 5 grand. But now they don't have that 5 grand because they don't have a budget for it, because it's not part of monthly expenses. It is a once-off that happens once or twice a year. So now what happens? They take that and put that on a credit card and say, well, okay, we'll pay it off over the year. And then what happens? It just stays there. You can't get, before you can pay it off, the next capex expenditure happens, and then you do it again, and you do it again, and you do it again. Before you know it, you're sitting at 30,000 Rand on your credit card. So the capex is, we plan the year in advance, and we say, okay, so let's go through every month and we see what are these once-off expenses that you need to plan for. The birthdays, the anniversaries, the Valentine's Day, the car services, the tires that you need to put on. All of those things are capex planning that you do. And with those two, the emergency fund and the capex planning, we create your reserve level, how much money you need in your reserve account. The goal for undergraduate level is to create financial security. So stability is having control over your cash flow and getting rid of your debt. Security is having a reserve account so that you become your own bank. Something goes wrong, you lose your job, you get retrenched, any of those things, you have money available to survive. You don't have to go to the bank and take out a personal loan to do it. So that is your reserve account. So the goal, to reach maximum reserve level, which your coach helps you with. Secondly, the outcome is to create financial security. And here the education we focus on is becoming or increasing your entrepreneurial intelligence. So we teach you and welcome back, everyone. That was Rikus Nel Hardekohle. I had a comment here from another Frikkie. He says, you see this guy knows his music. I wonder why. So Frikkie, I don't know if it's because he's sitting across from me and I guided him, or if his name is Frikkie. I think it's because his name is Frikkie. But yeah, well done. They're saying you know your music.
Awesome. Thank you.
Okay, guys, so we're talking about private equity, the buzzword, and we're going to talk a little bit about what is the risks involved, what you need to look at with private equity companies, etc., etc. One of the questions I had is, tell us a little bit about the kind of companies that you do invest in as a private equity firm. What are the sizes of these companies? I assume you're not looking for startups and those kind of things. What are the kind of companies that you invest in? And those companies, when do they contact you? How do you get in contact with them? How does that work?
So I think, thank you for the question. It's actually a very good question. I think let's look at the process that we go through to get to that specific point. And it's one of the things that when investors take a look at private equity allocation or companies, they first and foremost need to take a look at who are the investment managers, who are these guys, what are their skill sets, what are their histories, have they got track record, that type of thing. A lot of professional investors come to us, they say that the investment management company is 80% of the work, that the underlying companies that you invest in, it varies, but that's 20% of what actually happens. You need to trust and buy the investment manager and make sure they know what they're doing. So out of this regulated environment that we are, you've got your regulations on what you can do. You get an authorized mandate through the FSCA, you get your license, and you put together a team and you go. So there is constantly opportunities in the market that come forth that need funding or need strategy or need structure. So we go through a very, very rigorous due diligence process, and if it suits our investment style, the jockeys that runs the current businesses, there's a specific strategy that we follow when we talk to these guys. And we are majorly invested in financial services companies, so collections businesses, factoring, bridging finance, invoice discounting, purchase order funding, those types of things that we focus on. So we take a look at these businesses, these opportunities, and not only look to see if we buy a share or create a debt facility for this company. It's money in and then you walk away. That's not how it works. Before we even start to look at contracting, we must find out what's the value add that we as a business, as investment management, can add to this specific company. So you cannot just put money in and just hope for the best. You actually get involved in that business, take a look at their budgeting, their structures, their corporate situation, how everything is structured, increase the sales, and then you do a forecast modeling to see exactly what the situation is, what is the opportunities that you can actually, what is the return that you can look at.
Yes.
And if everything ticks those boxes, then you start throwing it over to legal, and they start drafting the contracts, which is about 180 lever arch files that you have to prepare. But and we also do not invest in the highest return type of opportunities. We don't want to shoot out the lights. We primarily want a specific return profile where we can do between 12 and 15% net yield return year on year. And we want the least amount of risk or the most amount of security to get to that specific. So this whole strategy we put together is 100% in there. So transport, yellow machines, renting, it's all part of our business that we did. Some of the exits that we have done, security company, we did car rental companies that we invested in and then exited as well. And believe it or not, other investment management businesses as well. So yeah, we actually bought out and grew two investment management companies, guys that have got a lot of skill set. We were battling to get into the market, one in Johannesburg and then one in Cape Town. We bought into these companies, and because we know the market very, very well, we grew these companies and actually sold them out to very, very high listed investment managers and made a very decent profit. So it's all relative to what we do.
Yes.
The core focus is there's massive risk management or mitigation strategies in place, and the investment manager that you choose, that's the crux of the decision.
Okay. Now, from a client or an investor side, how do they get involved with investing in private equity? Before you do that, we've got your website on, IFSAprivateequity.com. So if people want to find out more about IFSA, you can go to IFSAprivateequity.com. But if you want to share some of contact details, or where do people go to start getting invested in private equity or explore that?
So go to the website, send us an email. I think we've got an SMS number but we'll get to that a little bit later. I'm not too sure what the number is, but I'll get to that now. Where people can give us an SMS, and then we will return back to them. We've got a distribution team that actually works specifically to guide investors and advisors. I'm a very, very, very keen advisor, a partner, where I enjoy independent advisors that take good care of their clients, recognize that there's a need for private equity. They contact us, and we take them through the process to see exactly how it can fit and how we can add value to that client's lives.
Yes.
So private equity, 10 years ago, 15 years ago, more of an institutional type of investment. The last 5, 6, maybe 8 years, more retail-orientated companies that actually give retail investors access. So you can invest directly with a private equity with us as IFSA through a mandate that you sign, so directly there, or you can through a normal insurance endowment. You can have access to our funds, living annuities, even retirement annuities within parameters of what you can. You can get these the exposures to alternatives, which is very, very exciting for me around the new platforms and insurance companies that actually embrace the change that needs to happen.
So if you have a meeting with your financial advisor, you're looking at your retirement annuity portfolios or your your investment portfolios, you can ask them to give you some information on private equity as an option, as another asset class that you can add to your investment portfolio.
100%. If an advisor, and it's been difficult for advisors to unlock the value and actually get to the necessary growth that an investor needs without looking at the alternative market, because the alternative market is not correlated with the normal the JSE, the listed environment. So there is value in managing volatility, because it's a very, very smooth type of return profile, and within margin you will get to your investment goals not sooner, but there's a bigger chance that you will get to your investment goals if you put private equity or private debt private markets as an investment asset class in your portfolio.
So that's I think one of the big things that people are concerned about, because it's something different, because it's not your typical investment. You put money into a retirement annuity and they put it into a unit trust. What are the risks involved? Is it a higher risk, a lower risk than your typical unit trust equity investment? And how do you manage that? And what are the kind of returns that people can potentially expect from a private equity fund?
Also, a very, very good question. So a risk and reward goes hand in hand. If you take a higher risk, which private equity, according to classification, is a higher risk asset class. Same like equities. Equities is also a higher risk class, but it's not gambling, if I can say.
Yeah.
It's very methodical and very risk mitigated type of situation that you find yourself in. For me, that's been in the private equity space for so long. Yet again, your investment manager and the skills that you've got is the most important part. But over and above that, all the risk mitigation strategies that we put in place, with the inclusion of debt, where we've got a cash flow coming from these specific investments, how we get involved on a day-to-day, how we add value, what the strategy is. We make sure that we've got enough security in the investments that if something would go pear-shaped, or we clinically see that our strategy is not working, we can wrap up and we can actually have return of capital because we've got the security. So that's in a nutshell, is we've got that specific security. But we are also regulated with the FSCA with a license number, so we've got a lot of compliance hoops that we run through, and a lot of I would say outside party or third party service providers, independent auditors also on different levels. We've got independent administration that's also a licensed entity that does administration for us. And then on the valuations, as I think I said before, where month to month we've got external people that are not affiliated with us, that are not motivated by any financial means.
Yes.
They get a fee, they value it, and they call a spade a spade. So out of a risk structure point of view, we've got it covered. The only risk that I have seen that people do not see as an actual risk, which is actually the risk, is their advisors should plan for the liquidity restraint in private equity.
Okay.
Private equity or private debt is not an in and out type of strategy or in and out type of asset class, much like a property in personal. You cannot sell it today or withdraw half or whatever the case is. So when you do your planning, make sure that it doesn't fall within your first bucket or your reserve account or with your normal vanilla investments that you've got access to. Make sure that it's been planned as an income generating type of asset class, but it's more for a 12-month or I would say 3-year plus type of strategy that you know that you wouldn't need to get that capital back. You've got that in your planning, and that for me is the biggest risk, is the liquidity.
Yeah. I think that's there's two things that stood out for me from what you said is, if you go and buy shares in a publicly listed company, you don't have security. The publicly listed company doesn't have to give security for the shares.
Correct.
Where with private equity, you guys won't invest unless there's security that can cover that investment. So that's already a risk mitigation for me. The second one is that, yes, it's not trading shares on an ongoing basis. So you know when you go into a company, you're with that company for a period of time because that company has to grow. It's not like you can buy shares in Eskom today and tomorrow you can sell it again. It is something that you have to be with for a while.
100%. And that's why if you take a living annuity for argument's sake, you allocate, say, 10, 12%, 15%, whatever your risk parameter is, your risk rating is, to a private equity solution that you know that you will only need to access that capital in your living annuity from 7 and 10 years on.
Yes.
So you've got enough time in that portfolio to fully capitalize on the upside.
Yes.
And you don't need to put your hands on that capital again. And that's how the strategy in in a discretionary investment also should look like.
Yeah.
You cannot put your day-to-day money into private equity. You will have a liquidity issue because you cannot liquidate these positions. It's very irresponsible to take that stance.
And that's something I really like about private equity, is the fact that you can structure it in such a way that it will give you income, it will give you liquidity, and it will give you a return on investment, almost like a property investment. You invest in a property, you get the rental income, but the property value is supposed to grow as well. We're not going to talk about the property market, but the property value is supposed to grow as well. So you're getting the capital return and you're getting the income, and that's something that you have access to through a private equity structure, which you don't have access to through a normal traditional investment structure to a large extent. I mean, you do get 100%. Some dividends and everything, but it's not to that extent.
You are 100% correct. Our fund, the Cornerstone Capital Private Equity Fund, we've got a mandate that we try to have a net return between 12 and 15%. The income is between 12 and 13%. So the idea is that over term, you've got your steady income and you've got your capital appreciation on top of.
Yes.
Exactly like you said, like a property type of investment. And you don't know exactly what the return profile would be on top, but that's basically what you can work with. So we don't enter into a transaction that we know that we cannot at least hit those types of numbers.
Okay, so when we come back, we'll continue talking. We're going to talk a little bit about the contact details as well. But for now, we're going to take another music break. It is 22:11. Those of you watching on social media, we're going to continue with the financial coaching video. Show you how do you become a successful entrepreneur. Okay, so the next level, once you've reached maximum reserve level, you go to graduate level. Now, graduate level is where we start building a capital asset for you. So that is a positive cash flow that you have now created that flows over your reserve account into what we call your free bucks account, which is a flexible investment account that your coach and RRH will help you set up. This is to build a capital asset. So the goal for graduate level is to reach investment level. Now, what is investment level? So through the training that you receive undergraduate level, you will be able, with your coach's help, to determine what is the ideal asset that you want to invest in. Do you want to invest in a capital asset? Do you want to invest in a business asset, or do you want to invest in a fixed asset? In consultation with your coach, you will decide on a strategy. And once you have that strategy, the coach will calculate how much capital you need to make your first investment. Once you have that goal, you now have your investment level, and you start building your free bucks account to reach investment level. So the goal for graduate level is to reach investment level. The education area we focus on here is to increase your investment intelligence. So this is where your coach works with you, educates you to understand the different kinds of investments so that you can choose which one suits you best. And the outcome is to create financial gain. So gain meaning we're now starting to build an asset of money or pot of money that can work for you instead of you working for it. That is called financial gain. Also at this point, you want to start building your your first business asset. You want to become an entrepreneur and start creating alternative sources of income. Once you reach investment level, you then go to the last stage of the coaching, which is investor level. So you become an investor. So the goal for investor is to reach the breakout point. Now, just quickly what the breakout point is, it is where your income from your assets are equal or more than your active income. What is your active income? It is the income that you earn from your primary source of income, your job or your primary business, the money that funds your lifestyle. If you have assets, let's say for example, you've got 2 businesses that you are a shareholder in, you've got a few properties, you've got a few other assets that generate income on a monthly basis. If that money from all of these assets are equal than the money you Welcome back, everyone. And that was I Want to Hold Your Hand from the Beatles. Showing your age a little bit here. Okay, so we spoke about the risks involved. If you had to give a potential investor some tips, what kind of tips would you give a potential investor to say, make sure that you are investing, that firstly, private equity is right for you, and secondly, to find the right firm to invest with so that you don't get caught up in any kind of scam or anything like that?
100%. What I suggest is you should have exact knowledge of what your personal situation is. What is your risk profile? What is your investment strategy going forward? What is your returns that you actually want and need? So get to the planning first. And then after you did your planning, you can see if you can incorporate the asset class of private equity, which in my experience is not if, you definitely need private equity. It's just
How
where
much?
and how much. So the risk profile will determine exactly how much you have to allocate as a percentage between 2.5%, 15%, 20%, but whatever is your risk profile and your return profile that you need. That's the first thing that you do. After that, do some research on private equity companies, retail private equity companies, and meet the people. Actually talk to them, have a conversation. But always make sure that you're talking to people that are licensed with the FSCA and have got at least a 5-year track record on book, that they've got audited financials of the fund and they reported it out. And then also a very, very good idea is to ask for referrals. Joe Soap, that has been invested with the business for a couple of years, they are a client and they can tell you exactly what the look and feel of the companies are, what's good, what's bad, what needs to be improved, whatever the case is, just to make sure that you get that behind the scenes information.
Okay. And how does the cost of a fund like a private equity fund differ from the normal fund management cost? Is it similar? Because you basically have your ETFs, which is your cheap ones. Then you've got your bigger ones, which your unit trusts and those kind of with big fund managers. Where does private equity, is it more expensive than your typical fund to run? Is it cheaper than your typical fund? How much is the cost?
It is a little bit more expensive than a typical unit trust fund. But if you go and look at an equity unit trust, the costing is around the same. We do a flat 2% per annum fee. That's all in. That's to run the whole from risk management straight through. And we do a 20% high watermark as well.
Okay.
So and what makes us very, very unique as a business or as a company is we preempted that we will make a profit as a business when our clients or investors make profit.
Yes.
So we only trigger the high watermark or the performance fee when we exit a specific business. Okay. So when we realize that capital, we get that specific, we get that upside. So we are as motivated as the client to get to that specific point. The management fee just covers the cost and makes sure that we run the business appropriately and have got enough investment out of a capital or resources point of view to make sure everything runs smoothly. But the profit is at the end when we exit.
Yes. Now, one of the final things that I think we can chat about is a little bit of regulation, because when private equity started coming on the scene, there wasn't a lot of regulation around private equity.
Correct.
How has that changed? How is it does it make your life a little bit more difficult, and how does it make your life easier being regulated? And what should people look out for from a regulation perspective? Where can they go and check to make sure that this company is properly registered, etc., etc.?
100%. Look, people think I'm crazy. I love the regulated space because it gives you a framework of where you can work, and everybody in that same space has got the same rules to adhere to. So there's nothing weird or wacky if you're in a regulated space. So number one, FSCA a category 2 approved license with the different subcategories. What one can do is you can go on the FSCA's website and go and search regulated entities, put in the license number, and make sure that the people that you are dealing with is the people that you're actually seeing on the website,
Yes.
and that you've actually met. So that is categorically important. Out of a reporting point of view, that's why we as an industry like to have independent administrators. That is very, very important. In-house administration and reporting, I'm not a fan of, because I like the independence. The same thing with auditing, the same thing with valuations as well. Have external parties that are professionals that put their stamp of approval and their qualification at risk to say this is an actual situation of what the fund is basically doing. So that's very important, and you can go and check that on the website as well. Go and look who's the service providers of the business or of the company, and actually phone them as well to say, listen, how is this business doing? And just make sure that either your advisor or you yourself have those conversations with those people, so that you've got a feeling of what happens in the business.
Yes. Okay, so build a relationship. But like you said earlier as well, it is so important to buy the fund manager first before you buy the fund.
Correct.
Before you go and see the bright stars in your eyes with all the returns that you're going to get. I always say to people, you know what, you can put anything on paper. I've seen some horror shows where clients contact me and say, oh, we've put money into this account. And I say, guys, I've done some research. This doesn't look good. No, but they've given me statements, and you see how my money has grown. I say, well, you can put anything on a piece of paper.
Look, I feel very bad because there is a lot of nonsense happening, or what happened in the market, and people do get hurt. But it's very, very important. Regulation. That's why I'm a firm believer in that specific space. People think that private equity, private debt is this awesome, it's this sexy new asset class, whatever. And I always tell people it's the most boring job ever, because it's facts, it's figures, it's statements, it's lawyers. So there's not a lot of wow going into managing a private equity firm. It's not bells and whistles. It's actually fundamentals of managing. So it gets a bit boring. What I like is talking to people, getting the message out there, and actually educating people. That's how I've got a passion for the industry itself. So that's my little bit of upside.
Okay. Well, we got the SMS. You can SMS groot, so Afrikaans groot, or groot if you're an English person, to 48422. And they will give you a call back if you want to find out a little bit more and have a discussion. Frikkie, thank you so much for joining us. It was really great having you here and talking about private equity. If you want to give a final message to the audience on where private equity fits in and what you think, why they should be investing in private equity.
Thank you so much. It was wonderful to have a conversation. Thank you for everybody that's listening and watching. The bottom line is, make sure that you do your homework. There is definitely space in your portfolio for private equity. And the third thing is, contact us.
Thanks. And guys, thank you for listening. We're going to play out with our financial coaching, the last portion of the financial coaching. And then those of you on our Berg studio, we're going to play out with our final song. And that is from, what's his name? Joe Black, Een Klein Klippie. Those of you watching on social media, let's play out with our financial coaching. Thank you for joining me. Enjoy the rest of the week. And may the Bokke bring back the World Cup. I see it's a 7-1 bench. So it is going to be an interesting game. Cheers, everyone. Get from your job. You are basically free, because now we can take away the money from your job, and this money will be able to support you. And that is the breakout point, where the money from your assets are equal or more than the money from your job or your primary business. Because once you reach breakout point, you are free. So that is the goal for investor level. The outcome is to create financial abundance. Because once you get to that point where you have that freedom, it doesn't mean you're going to stop working. It means you're going to start working for a different reason. You're going to work because you want to work, not because you have to work anymore. If you decide to go into a different career path because that was your passion, you will have the freedom to be able to do it, because you don't need your job to support your family or to support your lifestyle anymore. That is true financial freedom and true financial security, because the money comes in whether you work or don't. Okay. And then the education area is, here we focus on increasing your emotional intelligence, because you need to start thinking like the wealthy. Guys, people who are wealthy, high net worth individuals, they don't think like an employee. They don't think like somebody who just wants to get a salary at the end of the month. They think on a different level. They have an understanding of how life works, how money works, and how business works on an emotional level at a much higher rate than somebody who's a middle class person that earns a salary. You want to start changing your mindset to start thinking like a wealthy person. Because there's a saying that says, wherever the mind goes, the body will follow. What that means is, if you don't change your mindset, doesn't matter if I give you 10 million rand today, if your mindset doesn't adjust, you will just go back to where your mind is comfortable. That's why so many people that win the lottery 6 months later, 12 months later, most people who win the lottery have nothing left. They've lost everything and they're back or worse than they were before they won the lottery. Because wherever the mind goes, the body will follow. They received the money, they got that, their bank balance changed, but their mindset hasn't changed. The mindset stayed the same. Therefore, the body, their outside world will go back to what they're comfortable with. So everything we do under investor level is to start changing your mindset, start making you understand the importance of paying it forward, of making a positive contribution to other people's lives. Now guys, again, like I said, you can't be an investor before you haven't been a student. You have to walk that first 2 steps in the forest before you can see another 2 steps and another 2 steps. Your coach will know what the route is. He will already understand what needs to happen under undergraduate, graduate, and investor level. So you can trust that your coach knows what the path is to your success. You need to focus on what's ahead of you, that 2 meters that you can see, and take those steps. Because standing still, waiting for the fog to clear to see the rest of the plan is not taking you anywhere. You need to start taking these steps. And that is what the financial coaching does and helps people with. So guys, again, if you are interested in getting involved, getting somebody to coach you, you are welcome to contact our office 087 809 0603. You can email us as info@retirehappy.co.za. You are also welcome to send me a message through Facebook. You can just search for Lourens Oberholzer, or you can look for me on Instagram, Lourens I Retire. You can look at me there or look for me there, follow me, and then send me a message through there if you have any questions. Guys, it was great spending some time with you, sharing with you what financial coaching means. And by all means, if you don't want to go through our financial coaching model, but get a mentor, get somebody who's been there, done that, who understands it, that can guide you. Don't let your ego get in the way of your success. Be willing to say, I don't know, or I'm open-minded enough to accept that I don't know everything about this subject. And if I learn more, I can earn more.
Financially raw, real, authentic wisdom with Lourens Oberholzer from Retire Rich and Happy.